All right, welcome to Coffee Talk. This is where we get to share with our community what's on our mind. We hope it's informational, fun, empowering. Hope you guys get a lot out of it, and let's go. For the first time in a long time, inflation is finally something that people are talking about. I mean, lots of people have been warning about it for a long time with all the stimulus that we've had, but it's actually starting to show signs of life.
So what a lot of people think has been happening over the last decade is we have a combination of inflation and deflation happening, and the net effect is unclear. So we think about we're on a camera that would have cost thousands of dollars years ago, and now like $20 in Amazon and delivered for free to your door in like 5 minutes. They're freakishly like sitting out there waiting to hand it to you. And all that costs like nothing. Well, that's massive deflation.
That's just driven by innovation largely, right?
Productivity. Yeah. Anything that increases productivity is essentially deflationary. And we hear about that a lot of times in terms of profit margins going up because the costs are going down. That's deflation. Right. And pretty much, most markets in the country are in some phase of pretty hot, with the exception of maybe, New York City and Los Angeles going through transition, San Francisco is going through transitional things with this remote work.
What's likely to happen to stocks, let's say stocks and bonds in an inflationary environment, if that's what we start seeing? Yeah. And then what are the other things that we might want to invest in to sort of mitigate the effects of inflation?
It's not really inflation or deflation that's the problem. It's the shock to the market of not knowing which direction and then figuring it out and then saying, oh, we have to adjust. Rates going up means bonds perform poorly. So longer dated bonds will have really bad performance in the short run. And the same with, if we just look at stocks in general perform very well in inflationary environments, except for the period when we figure out it's going to be inflation, because then everything needs to be repriced, for essentially the risk-free rate, which is treasury rates. So if those are going up, I might buy a stock now thinking, hey, an 8 or 10% return a year is a great thing. And then interest rates go to 7%. And I say, well, I want 15% for that stock. Right. And if the earnings aren't going up fast enough, I got to price it back down.
Right.
Real estate's kind of like business. It matters what kind of real estate. What becomes slightly more attractive in inflation becomes hotels, apartments, things that reset the price more regularly, because if it's a dynamic price environment, that's what you want. We like real estate for inflation, stocks for inflation, hard assets, commodities, and tend to lean toward commodities that have utility. So we're not big fans of gold personally, but oil, other industrial type metals and things like that would make more sense.
Yeah. How would we hedge ourselves or our clients' portfolios if inflation is in fact real?
And I would say in general, we're always hedged. I think the whole philosophy is to be a little bit wrong, right? So we have fixed income and equities, for example. One does well, in different environments. If we get a shock, they'll perform slightly differently. For us, we're doing strategic allocation. So let's say you have a 60% equity portfolio, 40% fixed income. We're not going to change that mix because of inflation. But within the portfolio itself, we might tilt slightly toward things that would benefit from inflation, things that can pass through their costs. On the equity side, we might move a little shorter on the bond side in terms of duration and maturity. And it's always the joke when we talk about these things that if we get really, really strong conviction that we're absolutely right about the direction of inflation or deflation, we'll still just do about that much, because these things are so easy to get wrong in terms of direction, but especially in terms of timing. So you can be positioned perfectly a year too early, and that would just be nothing in market time. Market timing wise, a year early is really easy to do. I think some of the value performance has actually been in anticipation of inflation, because if you look at those businesses that are at low valuations, they tend to be more industrial, traditional businesses where the input costs don't benefit as much from deflation, but they will absolutely get passed on to the buyer in an inflationary environment. And so that all has to get repriced. And they're also not trading at such valuations that depend on low interest rates to kind of support the comparison between treasuries or bonds and stocks, right? So to pay 30 times earnings for something, forward earnings, you have to be comparing to an interest rate that's basically zero for cash.
Check out how we help first by going to www www.paintedporchadvisors.com/help-first.